Hello everyone and welcome to today's web lesson. Our topic is CanSlim investment principles. Before I begin, I'd just like to say if I could recommend only one book or read only one book on investing, it would be How to Make Money in Stocks by William J. O'Neill. It's turned my trading around. I know when I started I didn't have very good results and the improvement was pretty drastic. So today we're going to go into some of the topics and principles in the book and try to explain the differences between other types of investing and growth investing, which is what CanSlim is. So we're going to do growth versus value, CanSlim versus conventional approaches, what CanSlim means, the buy and sell basics, the fundamental and technical components, how we use bases and charts to time our entries and exits, portfolio and position sizing, scaling in and pyramiding, our sell rules, which are many, and a lot of strategies and systems you'll find out there don't actually address sell rules, which is really one of the most important aspects of trading. It's how you lock in profit. The importance of cutting losses. And lastly, we're going to look at some charts and some historical precedent. We're going to see how the CanSlim methodology would be applied to various trades that have already happened. First, let's take a look at growth versus value investing. Growth investing basically focuses on companies that show consistent earnings and sales growth. We like to see 25% or more over the past 3 to 5 years. Whereas value investing, you're looking for companies that are undervalued or show signs of hidden value within their balance sheets. In growth investing, PE ratios are generally higher because they have better than normal earnings growth, whereas in value stocks, PE ratios are generally lower because their price is undervalued. And lastly, high quality products and services usually generate superior profits. That's return on equity and margins, as opposed to value stocks, where you have to wait for the market to recognize this hidden value that you've stumbled onto, and you can wait a long time. Another aspect you have to consider is the value trap, where it's undervalued, yet no one really cares, and then you're stuck in an investment that's not doing anything for a long period of time. Now, the CanSlim approach is different from conventional approaches. In the conventional approach, you buy low and sell high, but in CanSlim, it's kind of counterintuitive, but you buy high and sell higher. Conventional approaches, you buy on the dip, whereas in CanSlim, you never buy on the dip. You never average down. You never try to catch that falling knife. And we don't buy and hold. We'll hold a leader or a stock as long as the run is good, and then once it shows signs of weakness or that the run up is over, we sell it. We're dating the stock, we're not marrying it. Conventional approach likes to buy stocks with low PEs, whereas in CanSlim investing, we really never give PEs much attention. If you absolutely feel that you must have some kind of component in there that's similar to PE, you could use PEG. But as a rule, we don't focus on those particular fundamental components. And on conventional buying, when you're buying and holding, charts really aren't important because you're going to sit through whatever the stock market does. And in CanSlim, we always use charts to time our buys and sells. And a lot of people kind of fall into two camps. Either they love charts or they hate charts. But charts are important. If you had looked at a chart, you could have saved yourself a lot of agony during the 2008 crash, as opposed to buying and holding through that tremendous plunge. What does CanSlim mean? Basically, Bill O'Neill and his company did a lot of research, gathered some statistical data, and realized that there are basically 7 winning traits that propel stocks higher. And they are big sales and earnings. You want to see it in the current quarter. You want to see quarters accelerating. You want to see it in annual earnings as well. Basically, you're looking for big growth. You want to focus in on companies that have new products or services or something about them that dramatically changes or improves the way we work and live. You also want to focus on stocks that are in big demand, especially by institutions. And one of the ways that you see that is through spotting big volume, especially at breakouts. Also, we're going to focus on leaders, not laggards. A value stock is a laggard because people have yet to discover its value. We also want strong institutional sponsorship. We want a lot of funds owning it, and we want a lot of good funds owning it if possible. And the final component is we need to take all of the decisions that we make within context of the general market conditions. Now we're going to look at some buy and sell basics. Our buys are 70% fundamental and 30% technical. It means we want to zero in on stocks that have strong fundamentals. And when I say that, predominantly strong sales, earnings, and return on equity. Another helpful component is avoiding stocks that have high debt, especially relative to others in its industry group. We want to sell high and buy high. We want to scale into our positions. We'd like to have the stock prove itself to us. So as the price rises, it's saying, I'm behaving, so you can buy more. Always buy on the way up, never on the way down. We're going to use the charts to time our buys, because you can have a great stock, but if the timing's off, you can still lose money. And then we're going to hold this leader for the whole run, which is usually anywhere from 12 to 18 months, and then we're going to sell it. And we're going to try to take most of our profits at 20 to 25%. And we're going to try to take most of our losses at 7 to 8%. In a bear market, you're going to adjust these numbers. The main thing is you want to try to keep a 3 to 1 profit to loss ratio. So in a bear market, you might take profits at 10 to 15% and cut at 3 to 5% for your losses. Whereas in a bull market, you would try to hang on for the 20 to 25% profit and maybe give it 7 to 8% to fall before you exit. And selling is based on 100% technical chart action. A lot of stocks can continue to have strong, perhaps the best sales and earnings growth they've ever had 6 months after the stock has already tanked and topped. Now there's a few fundamental components we need to look at. We're going to look at the CAN and CanSlim. You want the current quarterly earnings. You want to see accelerating EPS. You want to see sales and earnings per share up at least 25%. Some of the best stocks are up 50 to 100% or more. It's also helpful to see increasing margins. As far as annual earnings, again, you like to see them up 25 to 50 or more % in each of the last 3 to 5 years. That lets you know that growth is sustainable. And a lot of companies that invest in stocks and move stocks up are the institutions, and they're looking for a place to park their money for 3 to 5 years usually. You want positive earnings. You want positive earnings estimates. You want current annual return of equity to be at least 17% or higher. Many of the best stocks will have well over 20, some over 100% for their return on equity. Again, you want to focus on newer companies that has an incredible product or service that changes how we live and work. Now let's focus on the SLIM, supply and demand. Specifically, you want above average increases on the breakouts, 40% or greater. That lets you know that institutional investors are getting in on this stock. That's one of the footprints that they leave when they're investing. We want to focus on leaders, and that means the top rated stocks in the top 6 sectors and the top 40 to 50 industry groups. Another way to find out if a stock is a leader or a laggard is you look at its relative strength line. You want something that's got at least 80 or better. It tells you that it's outperforming 80% of all the other stocks in that stock universe. And you basically want stocks that are fundamentally and technically superior to the other stocks in the universe. We're looking for institutional support. We want the number of mutual funds, banks, and other institutional investors increasing quarter to quarter, but especially in recent quarters. You don't want them decelerating. That tells you the big money's getting out of the stocks. The smart money is dumping the stocks. You want ownership by a few funds that have outperformed the market at least the last 2 or 3, well, 1 or 2, 2 or 3 years. That's the smart money. And then, probably the most important element is we have to know what the market direction is, because 3 out of 4 stocks will follow the general market direction. And you can't fight the market. So you want to buy when it's in a confirmed uptrend, not when it's in a downtrend, because you never know where the bottom is going to be. Here's a few technical components that we look at. We like to identify chart patterns on a weekly logarithmic chart. We'll calculate the buy point from a proper base, and that range where we can buy is from 0 to plus 5% from the pivot point. We want breakout volume, like I said, that's 40% or greater than the average daily volume. And we try to scale into a position as it proves itself. We've got traditional pivots, alternative entries, secondary buy points. Those are all 3 different places that we can purchase. And we don't buy extended. If it's 5% past our pivot, the risk becomes too great. So we're late to the party, we're going to leave it alone. And here's some chart patterns that we use. Now let's look at the life cycles of a stock. We're going to check out bases. We've got first, second, and third stage base. First and second stage bases are usually the best bases to buy a stock from. They're new, they still have room to move up. By the time you get to a third, fourth, or fifth stage base, it's questionable that the breakout's going to succeed. I believe 80 to 85% of third stage bases fail, and 90 to 95% of fourth stage or higher fail. So it's really important to get in early. 70% of the reasons to buy any stocks are due to the fundamental picture of the company. So we have to have that strong sales and earnings and return on equity. And although the fundamentals look great, we can't just jump in. We've got to time our buys in a thoughtful way that increase the probability of success. And IBD research shows that the average decline for a leading stock after it makes its run up is 72%. So you have a 72% retracement. Here would be a late stage, 4th stage base. It fails, and then it's going to plunge about 72%. So using a chart can really be helpful in timing buys and sells. We've got a few patterns that we pay attention to. We have cups with or without handles, and I'm not going to get into a lot of detail, but we will go over some of the basics. So you've got a few key components that will tell you whether or not this cup is going to be successful or not. It's shaped like a teacup when you look at it from the side. You've got a base or consolidation area that's 7 to 65 plus weeks or more. It's only going to be about 20 to 30% deep in a normal market. In a bear market, it might be as deep as 50% when it corrects. But you like to see a prior uptrend. Then you've got this correction, and then it forms a little handle. It's the last chance to shake people out. So 10% above the high in the right side of the cup will be your buy point. You add 10 cents to it and you're ready to go. The handle, it's important that it's only about 10 to 15% deep. The main stipulation being that it is in the upper half of this cup. If it falls lower than the halfway point in this cup, from the low in the base to the high in the base, then it's a faulty cup, and the chances of it working out are less likely. And you want cups that are U-shaped, not V-shaped. And here's a little information on handles. So here's the base, here's the midpoint of the base, and then here's the handle. And so you want the midpoint of the handle to be above the midpoint in the base. It needs to drift down, not wedge up. It usually lasts for 1 week or more. Hopefully the correction in a bull market will only be 15% deep at the most and 20% in a bear. And while this handle's forming, you want to see the volume, which is not shown here, dry up on a chart. The pivot is always 10 cents above the high in the base. Another one is a saucer base. It's like a cup with handle. It can have a handle or not have a handle. And it's pretty much the same thing. You like a 20 to 30% uptrend prior. That proves that the stock does have the ability to move up. Then it corrects in this consolidation. Then you have a handle. Once the handle goes above the high on the right side of the base, you add 10 cents, and that's your pivot point. Again, this will last 7 weeks or more. The next one we're going to look at is a flat base. It can be rectangular or box shaped, and it usually lasts at least 5 weeks. A box will last anywhere from 4 to 7. And it's typically 15% correction in a bull market, and usually not a first stage base. It's often like a continuation of an upward move where the stock is taking a rest, kind of gathering its strength to go up the next leg. And again, the pivot is 10 cents above the high left side of the base. So here was the high, and then you add 10 cents, and that's your breakout. And one of the key components is at least a 30% uptrend prior to this consolidation. Another popular base we use is the double bottom base. It's shaped like a W. Its length is 7 to 52 weeks. The depth is usually not more than 50%. The important part of this is for the second leg of the W to undercut the first. If it doesn't, it's a faulty base, and the probability that it'll be successful is decreased. It can have a handle. A handle is basically a last stop shakeout. It's the last chance to shake out the weak holders, and then the stock is able to move forward. And again, the high is above the 10 cents. It's always above the high in the middle of the W in this particular chart pattern. Another base that we don't see that often is the ascending base. A series of 3 moves up with 3 pullbacks, always going to higher highs and having higher lows, usually lasts 9 to 16 weeks. And the pullbacks are usually 10 to 20% at each little pullback. Right here. It's more than likely not going to be your first stage base, and it's often formed when a stock is resisting a general market correction. So as other stocks are falling, the stock is so strong that it's trying to make it up, and then it's getting pushed down. Then it keeps trying and keeps trying, and eventually when the general market changes back to an uptrend, it will break out. Now we're going to address portfolio and position sizing. A quote from Gerald Loeb: "Put all your eggs in one basket and watch that basket carefully." That is the general concept behind the portfolio and position sizing for CanSlim. You don't want to be so diversified that you're unable to keep up with the stocks that you have and give them the intensified attention that they need. Portfolios of 50,000 or less should only have 4 stocks at the most. 100,000 to $1 million, 5 to 6 stocks, and over $1 million, 7 to 8. One thing you want to make sure is that you don't over-concentrate in one industry group. You do want some diversification. You don't want to own Facebook, BitAuto, and Auto Home. You want to try to diversify within the industry group, but keep the number of stocks that you have small enough that you can give them great attention. So, portfolio and position sizing. Basically, a stock is like an employee. You have good employees and bad employees. And when you first get an employee, they need to prove themselves to you before you give them your trust and confidence and more responsibility. And in this case, more of your capital. So if you had $100,000, you divide it between 4 to 5 stocks. So say we'll do 5. So that means you can allocate $20,000 for each position, for each stock. At the buy point, that pivot point that's 10 cents above the high in the base that we were just talking about, you would buy half of your position as it's breaking out. So that's $10,000. Then when the price rises a little bit more, say 2 to 3%, you add another 30% to your position, which would be $6,000. Then when it rises 3 to 5% more from the buy point, you add that final capital investment of 20%, which is about $4,000, and now you have a full position. That's scaling in. And one of the reasons you do that is you don't want to just jump in. You know, you're kind of testing the water, you're putting your toe in, making sure everything looks good, or making sure that employee is a good employee. Now you want to add to your winners. This is one of the key things that the CanSlim system has, is the concept of force feeding your winners. So you're going to look at the stocks that you have and you're going to evaluate them according to the percent that they've gained. And you want your best performers to become your biggest positions. And what you'll do is, which is actually against human nature, is you're going to sell your weaker positions. You're not going to wait around for them to come a little higher or come back up to zero. You're going to get rid of them, and you're going to take that capital, that money that you get from the sale, and you're going to start slowly increasing your position into your big gainers. And you're going to do that by pyramiding at secondary buy points, like pullbacks to the 50-day moving average, 3 weeks tight patterns, a short stroke pattern, second stage base breakouts. And as you do this, you're going to progressively add less and less shares to keep your cost average down. As far as selling goes, you're very unlikely to sell at the top, just like you're unlikely to buy at the bottom. And selling is a lot more difficult than buying because you have hope, greed, fear, and pride. All your emotions start to come into play. You hope the stock will bounce back if it's down, and so you do something foolish like average down instead of cutting your losses. Or fear will overcome you and the stock will reverse down after you have a little profit, and you'll sell it because you're desperate to keep what little you have, and then it goes back up without you. I don't know anybody that has not happened to. Then you've got to deal with greed. It's reached 20 to 25%, and you don't want to sell it because you think it's going to keep going higher. Maybe it will, but studies have shown that after a stock rises to 20 or 25% above the pivot point in a proper base, it will start to consolidate and form another base. So then you have to decide, are you going to sit through a 10, 15, 20, 35% correction? And you also have to factor in, what's the market doing? Is it crumbling? Are we starting to slide into a bear market after a 3-year bull upswing? Then you also have to contend with your pride. Is everybody likes to be right. You know, I know this stock's going to go up, so are you going to hold it until you're proven right? But in the meantime, it falls dramatically. When to sell? You've got to factor in your objective, the type of trader you are, your price target, the price and volume action of the stock. Is the stock acting strong or is it acting weak? Is it starting to consolidate into another base? What's going on in the general market? But we usually want to take 20 to 25% in a bull market and 10 to 15% in a bear market. If you have a stock that's doing fantastic and not showing any weakness or any sell signals, I would suggest that if your greed gets the better of you and you're unable to sell, at least take a partial profit. At least sell a quarter to a third to half of your position, so that if it should reverse, you've secured some profit, and then perhaps tighten your trailing stop on the remaining balance. Here are some signs of weakness. We can classify them. into market breakdowns, breaking support and resistance, institutional evidence that it's weakening, volume up or down, and company problems. How many times has a news report come out with scandal or too many excessive stock splits or a severe drop in earnings growth or an inside selling that can really push the stock? Another way to look at all this is in terms of offensive and defensive selling. Offensive selling is climax tops, breaking upward channels, sharp pullback, fast recovery, rebounding on light volume after a tumble, new price highs on low volume. Defensive selling would be closing below a major uptrend line or breaking below the 50-day average, moving average on big volume, large one-day losses, distribution tops, things of that nature. And there's positive and negatives to offensive selling and defensive selling. Offensively, you sell a stock too early and then the stock keeps going up without you. Then you feel pressure to get back into the stock and end up buying when it's extended. Defensive selling, you might give back a large percentage of your gains. The stock has gone up and now it's tumbling, and sometimes that's psychologically more difficult to cut or sell a stock after it's gone up and lost. You keep hoping it'll go back up just a little bit to where it was so you can sell. And there is that tendency to hesitate or rationalize. Another factor is the market, if there's a lot of selling going on, may not be liquid enough to absorb your shares, and your selling might push the stock further down. And that's one of the reasons we try to only get stocks that have a strong liquidity. But let's look at how important it is at cutting losses. When you lose 20% of your capital, you actually need 25% to break even on the remaining balance. So if you lose 50% of all your money, say you had $100,000 and now you're down to $50,000, you have to make $50,000, which is in essence 100% to get back to even. And as your losses mount, the amount that you have to get back to even, to recoup those losses, starts to increase dramatically, exponentially almost. So you really want to nip them, keep them short, no more than 7 to 8% in a bull market, 3 to 5% in a bear market, and keep those losses down. Now let's look at this. If we maintain this 3-to-1 profit ratio, maybe on the first stock, it's a bull market, things are going, I make a 25% gain. Then I have a series of bad luck and I take 3 losses in a row. Well, I still have a 4% gain when all's said and done. In a bear market, same thing. I get a 15% gain, and then I have 3 losses of minus 3% in each one, and I'm still up 6%. Let's look at a couple of charts and see how we might apply the CanSlim methodology. There are many hard, fast rules in CanSlim, but there's also a lot of discretionary choice points. And the larger your profit is, the more options you have for how you can manage the trade. Here's Apple in 2004. It increased 1,400+% in 199 weeks. Here we have a second stage cup with handle and some tight areas, which is a sign of technical strength. It makes a little run up and then consolidates. It did not run up 20% or more, so we consider that a base on base, and it would still be a second stage base, but it would be a flat base in this case. So it bounces off the 50 with strong volume, closes strong in the upper half, upper 2/3 of the day's range. That's a good place to add to your position. Has this nice run up before it consolidates again into another flat base and pulls back to the 50 with another strong bounce with good volume and good closes. Another place you could add. Rises, then starts to form a 4th stage base. Now you're not going to add at this 4th stage base because 90% of bases that are in the 4th stage or higher fail. And this one does. You can see it pulls back, actually crashes through the 50, spends several weeks under that moving average until it finally consolidates, comes back above the 50 with some positive volume, and breaks out of this consolidation. You could add there. Then it makes another strong run up. Here it starts to consolidate again, but you're not going to buy it. It's only got 3 weeks, and 3 weeks is not a proper base. It's also up over 100%, and that's pretty significant. You might want to take some partial profits there if you haven't already. It corrects severely, falling under the 50-day moving average, finds some support initially at the 200, then crashes back through it. That forms a double bottom base. So as it breaks out of this double bottom base, you can add to your position. And it runs up a little bit and falls back down below the 50. It kind of hugs it for a while tentatively. Then finally, you could call this a cup with handle, or you could call this in here a flat base. I suppose it's all in your perspective and interpretation skills. Then it finally runs up. So every time it breaks out of a sound base or has a strong breakout or bounce off of the 50-day, those are good places to add. It runs up, and then we start to see some warning signs. We've got a lot of distribution, a lot of red, a lot of selling. It falls back to the 50, doesn't really bounce off it strongly. Then we start to see new highs on low volume, which is a sell signal. Also, it's had this great run up, and it's been a run that's lasted 4 years. Everything comes to an end, and you've got to know that it's probably time to start acting defensively. Now, there are several ways that you could have handled this trade. You could have taken partial profits anytime it fell below the 50-day moving average, or really any boss average, any moving average that's holding the bulk of the move. Once it violates that, you can be defensive, you can take some partial profits. Then when it resumes its uptrend, you can always add back to your position. You don't have to sell everything. You can have a core position that you trade around. Once you have a really large profit like you do in here, you've already got 100%. Now you can handle the stock much differently. You could maybe take partial profits when it breaks the 200-day, or you could go all out when it breaks the 200-day. There's a lot of discretionary choices. Something else you want to think about is how many bases has this stock formed, and how many cycles of bases. So you have 1, 2, 3, 4 bases. Maybe it corrects, it resets the base count, and then again you have 1, 2, 3, 4 bases. You've got to know that the party is starting to get late. Most winners, their run will last 12 to 18 months. And most institutions are looking to put their money in a stock for 3 to 5 years. Well, this stock has run up for about 5 years, 4 or 5 years. So that's a signal that it's time to shift from an offensive stance to a defensive stance. Here we have JDSU. It increased 2,000% in 66 weeks back in 1998. A lot of times people say, well, when's the best time to buy off the 50-day moving average? It's the first or second pullback. And then also you want to see big volume and a strong bounce with a good, strong close. Those make excellent points to add to your position. So we've got this first stage cup with handle. Well, it's 22 weeks long. It breaks about above the buy point, has strong up volume on the breakout. We make our purchase, we've scaled in, so we've got our core position. It starts to run up. It makes this a normal pullback to the breakout point, and when it crosses back above, you can add to your position. So here are 2 points. Then it makes this nice run up, falls back to the 50 once again. However, on this one, we don't have strong volume, and we don't really have strong closes. So maybe we won't add there. And again, here, it comes off the 50, but not in strong, overwhelming demand. So I might refrain from adding. Finally, it makes another pullback, and this time we have tremendous volume, nice strong closes in the upper 90 percentile. I'm going to add to my position. It runs up, consolidates, forming this flat stage base with tight closes, breaks out above it, add a little bit more, and again you can add off the 10-week moving average line. So it runs up again, another consolidation, another pullback. And the whole time you're paying attention to the volume, making sure that you've got strong support for this move. This is Qualcomm in 1999. It went up over 2,000% in 45 weeks. Strong bases. This is a great example of faulty bases and what a strong and proper base looks like. When a base is forming, you want half or more of it to form above the 50-day moving average. You also want the formation of the base to be in the upper half of the base, not just at the bottom of the base. You want to see strong closes on the right side of the base. You want strong up volume. At the bottom of the base, it's nice to see weak closes, churning, stalling, anything to the downside that indicates maybe the selling is starting to exhaust itself. Here we have what looks like a base, but we're not going to buy it because most of it is in the lower half. You can see how the upper part of the base and the lower part, it's all the formation is at the bottom. Finally breaks out, doesn't do much of anything, runs sideways and then collapses, and it forms three bottoms, and that is not a base. And you have all this huge distribution, these skyscraping red volume. Finally moves above it and then tumbles back down into another base. Again, it's forming mostly in the lower half. Not a good sign. Continues to consolidate and go sideways until finally it forms this 24-week cup with handle that is a proper. It has some strong up volume throughout the base, and as the right side of the base forms, you're seeing more positive volume than negative volume. So it breaks out, and you'd buy your core position here. Makes this lovely run up. Look at that, really nice. Finally comes back to the 50. Notice these strong closes at the top of the range. Notice this big volume. Got volume that's up. So we'd add to our position. Then it forms the ascending base that we talked about earlier. So it consists of three pullbacks with higher highs. When it breaks out, you could add to your position. Then it looks like we have this 4-week high tight flag. That's another pattern we covered. So when it breaks out from there, you could add a little bit more. Now, where you start to see some yellow flags is you see this climax top right here. And once you become aware of a climax top, you want to start scaling out. And especially here, we have the strong, huge up day followed by this huge down day. That's a red flag. You want to get out. This is Taser back in 2003. It increased over 2,000% in 39 weeks. They're calling this a cup with handle. I'm not really seeing it. I do see some resistance. It breaks above. You could have purchased here as it broke out. Or here it has this consolidation, pulls back to the 50 with a strong bounce with big volume. That's the place that they would have bought. They would have recommended you buy. Runs up, pulls back to the 50. You could add a little bit more, and then keeps going. And what you have here is a very unusual series of 3 high tight flags. So you've got this big run up, and then you've got the flag. You've got a nice run up and a flag, and another run up and a flag. Then this pullback to the 50, and you could have added. It's pretty parabolic, so you'd want to make sure to be on the lookout for any kinds of warning signs. The volatility on the weekly swing, price swing, has increased. About the high tight flag, it's usually 4 to 8 weeks. It can be more. It has 100 to 120% uptrend before it pulls back and forms the flag area, which can usually last anywhere from 3 to 5 weeks and can correct 10 to 20%, 25 at times. Here's Yahoo. In 1997, it increased over 6,700% in 130 weeks. You've got this nice cup with handle, lasts 64 weeks. You've got tight closes, a sign of technical strength. You've got good up volume. You've got volume on the breakout. You buy your core position that you scaled into. Then it runs up, pulls back to the 50. You wait till it comes back above the 50, and if the volume's strong enough, you have a nice little bounce here, you could add. Then it forms a 7-week base. It also has 4 weeks of tight closes, breaks out, runs up, pulls back to the 50. Every time it forms a base, every time it pulls back to the 50 and shows strength as it bounces above it, is a place that you can add to your position. Progressively, less and less shares to keep your cost average down. Then it makes this climactic run up, starts to really accelerate. And once you realize you're in a climax run, you want to be very cautious, shift to a defensive posture, maybe start scaling out into strength, because when they crash, they usually crash very hard. This one went sideways for several months, and who wants to be stuck in that? And then it made another little mad dash up. The main thing to keep in mind is, although there are a lot of hard-edged rules, you need to manage the trade in a way that fits your specific psychology. The way I handle a trade is definitely going to be different than the way anybody else handles a trade. I'm going to try to play into my strengths. Here's a shot of 2011, the top stocks that fit the CanSlim profile. You can see some of the top performers were 500 and 200%, and then down to 57%. That's just one page. There's several pages. Here's 2012. Again, 400% to 143, 46%. That's just the first page. So I'll show you this because I want you to know that even though we used examples from the past, there are still many, many stocks that fit the CanSlim profile that make huge runs up each and every year that you can participate in. Here's a list of the top 25 stocks over the last 25 years. Look at these gains. Pretty fantastic. If you want to learn more about CanSlim or download this and other helpful presentations, you can visit our website at the Tacoma IBD Meetup Group, or you can visit investors.com. If you have any questions, you can email me, and you can download the slides that accompany this web lesson on our website. Thanks for joining us.